5 seconds to the open. Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
All right, friends, welcome to this episode of the Follow the Money podcast. My name is Jerry Robinson. I'm your host and guide, and today is episode number 513. We're going to be talking about a major investment theme that I believe is still being underestimated by many investors. You know, Wall Street has been obsessed with artificial intelligence, and for good reason. I mean, AI is literally changing everything. It's changing software and business and research and automation, even just the way that companies operate. But there's another side of the AI boom that is becoming impossible to ignore. That word is power. That's what we titled today's episode, AI's Power Problem. AI may feel like something that lives in the cloud, but not the kind of cloud that is floating in the sky. It's sitting in massive data centers packed with chips and servers and cooling systems, transformers and electrical equipment, and every bit of that needs electricity. So in today's first segment, we're going to look at that problem, why AI is creating a major new demand shock for power, the grid, and data centers. And then in segment 2, we'll shift from that problem to the opportunity. We'll look at some of the key investment areas this theme is creating, including nuclear power, uranium, natural gas, grid infrastructure, and even data center cooling, which is a very interesting niche. So with all that said, let's dive in. So what if I told you that one of the biggest challenges facing the AI boom is not a smarter chatbot, not a faster semiconductor chip, and not even government regulation? What if I told you that it is electricity? That may sound strange at first because artificial intelligence feels weightless. It feels digital. It feels like something that lives somewhere out there in the digital cloud. But the cloud is sitting inside of these enormous data centers filled with all of this equipment, servers and chips and cables and cooling systems, and all of that needs power. For the last couple of years, Wall Street has been fascinated with AI stocks, right? They've been focused upon the chip makers, they've been focused upon the software developers and the cloud platforms, and obviously the mega cap tech stocks. And I understand why. You know, AI is a very different technology. It's not just another app on your phone. It's really changing how businesses operate. But today, I want us to look one layer deeper because the next phase of the AI boom is, again, not about the smartest model, but perhaps more importantly, who can power the machine. The International Energy Agency, the IEA, recently projected that global electricity consumption just from data centers could more than double by 2030, reaching around 945 terawatt hours. That's a big number, right? Data centers are becoming the new factories of the digital economy. The old factories needed land and labor. They needed railroads and oil. The new factories need chips and servers and cooling and data and enormous amounts of electricity. So the raw material here is power. The output that's coming out of this is compute. And if compute is becoming one of the most valuable resources in the modern economy, then electricity becomes one of the most important bottlenecks. And this is obviously an interesting story for investors because this is not the first time a major technological revolution created opportunities outside of some of the obvious companies that were affected. Think about when railroads transformed America. Investors did not only make money in railroad companies, they made money in steel, in coal, in bridges, banks, and insurance, and land, and the towns that suddenly became important because the railroad ran right through them. During the internet boom, everyone focused on websites, but behind the websites were networking companies, fiber optics and semiconductors, and all that infrastructure that made the internet work. I believe AI may follow a similar pattern. Yes, the large language models matter. Yes, the semiconductor chips matter. Of course, all the software matters. But behind all of it is a physical system that has to be built, powered, cooled, maintained, and financed. That's the part of the story many investors are still missing. So the question is not simply, can we generate more electricity? The real question is, can we generate enough electricity in the right places at the right time with enough reliability and at a price that still makes economic sense? That is a much harder question facing today's AI companies. Now, here in the United States, this power problem is already showing up. The EIA, the Energy Information Administration, expects U.S. power consumption to hit new record highs in 2026 this year and in 2027. Reuters has reported that AI data centers and the broader electrification theme is helping drive that increase. And commercial electricity demand is expected to exceed residential demand this year. It's really changing the way we think about electricity. Americans thought about electricity demand in terms of homes and factories and air conditioning and appliances, for a long time. But now we're beginning to think about things like data centers, these massive facilities that need huge amounts of power, and it needs to be reliable. And then, of course, you have to cool the chips inside of that data center. And of course, it needs grid access. And when the companies come in to build the data centers, they want tax incentives and they want cheap land and they want all of this. So you can see the collision that's coming, and we've been seeing it across the country. Big tech wants more data centers. AI models need more compute, and that compute needs more electricity. It needs more power, but the grid has limits, and local communities have big concerns about it because somebody's going to have to pay for all of it. And that is AI's power problem. It's not just a problem for the tech companies either. It's becoming a problem for manufacturers and households, utility companies, and regulators. A recent report from Reuters showed that big tech data centers are already contributing to higher electricity costs for many manufacturers in America's Rust Belt. One example involved an Ohio brick manufacturer whose monthly capacity charges reportedly jumped from $1,600 to $12,000. So it's just simple economics. We have power demand beginning to grow faster than the supply and the infrastructure that supports it. So costs are obviously rising, and rising demand plus constrained supply not only equals higher prices, but it also leads to potential delays and rationing, or some combination of all three. And that's the irony of all of this, actually, is that the digital economy depends upon the physical economy. And that's why these big tech companies aren't sitting around waiting for someone else to solve the problem. They are going upstream into energy. You have companies like Microsoft and Google, Amazon and Meta, all looking for ways to secure reliable baseload power for future AI growth. Many of them are signing long-term power deals. Some are exploring nuclear power. Others are looking at building their own advanced reactors. Some are partnering around power generation. And really, a lot of them are just trying to lock up electricity the same way companies used to lock up oil fields or rail lines or shipping routes. So power really is an interesting niche play in the AI story, because these AI companies are no longer just competing for engineers and chips and cloud customers, etc. They're now competing for megawatts of power. And as mentioned, these are scarce physical resources now. So the investment map is beginning to widen as the industry begins competing for these scarce physical resources. And I think this is where many people are missing it. They look at AI and they only see the obvious names. They see the chip makers, they see NVIDIA's, they see the cloud platforms, they see the software companies. And many of these companies, of course, are outstanding businesses. But the second order question may be just as important. Who benefits as the AI industry races to secure power, right? And who owns the power generation? Who's going to supply the fuel? Who's going to upgrade the grid? Who's going to build the substations, and who's going to make the cooling systems, and who's going to handle the electrical equipment? You see, these are the kinds of questions that investors should be asking. Now, we're going to talk about some of the opportunities that we see in segment 2, but first we really need to understand the problem. And again, the problem is this: AI demand is moving faster than the physical infrastructure needed to support it. You see, the digital world moves at one speed and the physical world moves at another. So you can see a brand new AI model be released quickly, or a cloud service can scale quickly, But you just can't build a brand new power plant, in a week. You can't upgrade the electric grid in a day, right? So that gap between the ambitions of the digital economy and the realities of the physical economy is where that bottleneck really lives. So when you think about artificial intelligence, you really want to think beyond just the large language models. You want to think about how are we going to power this, the electricity demand and the energy security and the grid reliability, right? It's obviously going to require all forms of power. For so long in this country, we've treated energy in a real political way. Oftentimes, one political party will say, well, we don't like this kind of energy. We don't like solar energy, or we don't like wind energy, or others will say, well, we don't like nuclear energy, or whatever the case might be. From my perspective, friends, we don't have that luxury. We don't have the ability to swear off certain forms of energy because we don't like them politically or we don't think that they can work. The fact is we have to be using all forms of energy. We need oil, we need gas, we need nuclear, we need solar, we need every form of renewable energy we can find, and it may still not be enough. Now, before we shift gears and move into segment 2, because I want to talk about some of these opportunities that we see, I want to add one more important point, and that is that identifying a very great trend is only the first step, right? So here at Follow the Money, we don't buy narratives, we buy trends, right? The story tells us where to look. That narrative is telling us where to look. The charts tell us when to act. And those are two very different things. I mean, you can find a great investment theme, but it can still be a terrible buy if you chase it and buy it at the wrong time. And a great company can still disappoint you if the entry point is poor. So yes, AI's power problem is a major megatrend. But that doesn't change what we look for when we go to invest, right? We still want to see discipline. We still want to use patience as we enter into these stocks or ETFs. We still want to find confirmation. We still want to use risk management. That's how we avoid turning a good idea into a bad investment. And believe me, over the years, doing this for over 20 years, I've made some bad investments, even with good ideas. So you have to use wisdom even in areas like this. So after the break, we're going to shift from this problem we're talking about, AI's power problem, to the opportunity. We're going to talk about the different investment layers behind AI's power problem, including nuclear power and uranium, natural gas, grid infrastructure, electrical equipment, and data center cooling. Because the best investors are going to figure out who's getting paid. Because obviously, fortunes are rarely made by following yesterday's story. They're made by recognizing tomorrow's bottleneck before everyone else does. So after the break, we'll talk about where those opportunities lie. Hold tight. We'll be right back. Hey friends, Jerry Robinson here from followthemoney.com. Before we continue with today's podcast, let me just mention something really quickly. If you've been listening to the podcast for a while and you're starting to think more seriously about your own situation, your investments, your retirement plan, and how everything is actually structured, there comes a point where it helps to talk it through with someone. And that's why we created our Follow the Money Advisor Referral Service. We work with a network of trusted financial professionals across the country, and we can connect you with someone who can help you take the next step, whatever that looks like for you. Maybe it's reviewing your current retirement plan, or maybe it's putting a real income strategy in place, or maybe you just have a simple question like getting a life insurance quote. If that sounds helpful, you can learn more at followthemoney.com/advice, or just give us a call at 800-609-5530. No pressure, just a chance to get some clarity around where you are and where you're going.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
All right, welcome back to the Follow the Money podcast with Jerry Robinson. One of the longest running podcasts devoted to your personal finances on earth. We've been around since 2010. You can find us online at followthemoney.com. We got lots of great resources there for free, but also tons for our members. Check it out, followthemoney.com. All right, so in our first segment, we talked about AI's power problem, right? The main idea, pretty simple. AI feels digital, but it's actually running on physical infrastructure, right? It runs on data centers and chips and servers and cooling systems and all this stuff, right? And ultimately, electricity. So now let's shift from the problem to the opportunity, because every single major bottleneck creates an important question for investors. I hinted at it earlier. Who gets paid to solve the bottleneck? That's really what this second segment is all about. Now, before I list a few names and a few specific areas that we're looking at, let me make the usual disclaimer here. This is not personal investment or financial advice. I don't know your personal financial situation or your risk tolerance. I don't know your time horizon or your portfolio. So you do need to do your own research and use proper position sizing. Never buy anything just because you heard a ticker symbol on a podcast, right? With that said, when I look at AI's power problem, I see several investment layers worth looking at. And I want to walk through them in a way that makes sense. That first layer is nuclear power, right? So now nuclear power and uranium are related, but they're not really the same thing. And I want to make that distinction. A nuclear power company sells electricity. A uranium company supplies the fuel to the nuclear power company that sells the electricity, right? So those are related, but they don't always trade the same way. So when we talk about the AI power trade, I'd like to separate the nuclear theme into three buckets. First, the companies that already generate nuclear electricity. Second, the uranium and nuclear fuel cycle companies. And then third, the more speculative advanced nuclear names trying to build the next generation of reactors. Okay, so that may sound like I'm splitting hairs, but really it matters. You have different risks, different timelines, business models, different levels of volatility, all this, right? So a nuclear utility is not the same thing as a uranium miner, and a uranium miner is not the same thing as an enrichment company, right? And so all of that just needs to be understood at the outset. So let's start with the power generators. So when AI data centers look for electricity, they are not just looking for cheap power. They need reliable power. They want electricity available around the clock. And that is why nuclear power has come back into the conversation with a vengeance over the last few years, right? Solar and wind can absolutely play a role in the broader energy mix, and we need it. But AI data centers do not want electricity only when the sun is shining or when the wind is blowing. Now, I know there's storage solutions for solar and for wind, but still we're at a place where we need uber reliable electricity. And so therefore, until those storage solutions are further up to speed, we want to integrate them into the system, but always have reliable backups in the meantime. So nuclear really provides that base load power that these companies are looking for, and that's why companies like Constellation Energy, ticker symbol CEG, one of my favorites in the space, and also Vistra, ticker symbol VST, have attracted attention from investors watching this AI power theme. Constellation is one of the largest nuclear power operators in the U.S., and Vistra also has nuclear exposure along with a broader power generation footprint. Now again, these are not uranium miners, and they are not speculative reactor developers. They are power generation companies. So if the question is who already owns these large-scale electricity generation assets that could become more valuable as AI demand rises, names like CEG and VST certainly belong on that watch list. Now again, that doesn't mean buy them at any price. Some of these names have already had big moves. So do your due diligence, just as you would with any investment theme. All right, the second nuclear bucket is uranium and the nuclear fuel cycle. This one's also very interesting. This is where we move from power generation to fuel supply. So if nuclear power becomes more important, then the fuel behind nuclear power obviously is going to become more important too, and that brings us to uranium. Here, one of the quality names that investors often look to, and quite frankly my favorite, is Cameco, ticker symbol CCJ. Cameco is one of the major uranium companies in the world, and for many investors, it's also one of the cleaner ways to get exposure to the uranium theme. Then there is Centrus Energy, ticker symbol LEU. Centrus is a very different kind of story because it's tied more to the nuclear fuel cycle and enrichment side of that equation. It's a much more specialized and certainly more volatile name than Cameco, but I think it deserves a look. And then, of course, there are ETFs, uranium ETFs like URNM, that's the Sprott Uranium Miners ETF, and also URA, the Global X uranium ETF. Those two ETFs give investors basket exposure instead of forcing them to, into a single stock risk. And I think in an industry as volatile as the uranium space, that can make a lot of sense for most people. If you've never looked at the uranium space, you'll be surprised that these stocks can move very violently. They can go through long dead periods, and then they can have explosive rallies when the supply-demand story begins to heat up. So don't think that this is a low volatility corner of the market. But since we believe that AI-driven electricity demand is going to increase the market's appetite for nuclear power, then uranium and nuclear fuel cycle stocks deserve a place on the watch list. Now, the third nuclear-related bucket is advanced nuclear, right? Now, this includes smaller, much more speculative companies that are working on advanced reactors and small modular reactor technology. One name that I have discussed a lot with our members, and I've even thought about buying, I haven't pulled the trigger yet, is the company called Oklo, ticker symbol OKLO. Now, this is not the same kind of investment as Constellation Energy or Cameco. Oklo is much more speculative. It's even pre-revenue. They're not even making money yet. And it's tied to the idea that advanced nuclear reactors could eventually help provide reliable power for these data centers. And the upside could be large if the company executes over time, but there's lots of risk here. Regulatory risks, execution risks, financing risks. Again, this is the kind of name that belongs in the speculative bucket, not the sleep well at night bucket. So if we think about the nuclear stack, we have power generators like CEG and VST. We have uranium and fuel cycle names like CCJ, LEU, URNM, and URA. And then we have advanced nuclear speculation with names like OKLO. Now let's get into the second layer. And the second layer is natural gas. Now, some investors may not want to hear this, but natural gas is likely to remain a major part of the AI power story. Nuclear may be the cleaner long-term baseload dream, but natural gas is highly practical, and it's already deeply embedded in the U.S. power system and can often be brought online much quicker than nuclear. So if electricity demand keeps rising, which we expect it will, then natural gas may continue to play the role of a bridge fuel while the country rebuilds its nuclear and uranium industries. Now, when it comes to natural gas, there are three basic buckets here. The first is natural gas producers. I think of names like EQT, which is ticker symbol EQT, which is one of America's largest natural gas producers with major Appalachian exposure. And then you have names like Coterra Energy, ticker symbol CTRA, which is much more diversified but still has meaningful natural gas exposure. And then, of course, you have those higher beta natural gas names. Some investors look at companies like Antero Resources, ticker symbol AR, or Range Resources, ticker symbol RRC. These producer names are usually very sensitive to natural gas prices, which means they can move quickly in both directions. So when gas prices rise, they tend to respond, and when gas prices fall, they tend to suffer. Now, the second bucket when it comes to natural gas would be midstream and pipelines. This is where you find companies that move natural gas around the country. I think of names like Williams Company, ticker symbol WMB, and Kinder Morgan, ticker symbol KMI. Now, these companies are not pure bets on the price of natural gas in the same way producers are. Some investors also look at names like Energy Transfer, ticker symbol ET, or Targa Resources, ticker symbol TRGP, depending on what kind of midstream exposure they want. Now, the third bucket when it comes to natural gas is LNG, or otherwise known as liquefied natural gas. Here, Cheniere Energy, ticker symbol LNG, ironically, is one of the major names. But that name is really more about global gas demand and exports. It may not be the cleanest AI data center play, but it is definitely part of the broader natural gas story. So for this episode, I would likely say that the cleaner natural gas watch list names to understand are EQT, WMB, KMI, and Cheniere, which was ticker symbol LNG. Again, not recommendations to buy today. These are watch list names for you to research, names to understand if AI-driven power demand keeps pushing electricity needs higher. Now this brings me to the third major layer, which is the grid and electrical infrastructure. And honestly, this may be one of the most important layers of the entire theme. because it's just not enough to generate the electricity. Once you generate it, then you have to move it and manage it, distribute it. You have to connect it. You have to make sure the system can handle the load. And this is where the AI story becomes a grid story. And of course, the grid is not glamorous. Nobody's sitting around at a dinner party saying, let me tell you about my favorite transformer stock, right? And if they are, you might want to check on them. But from an investment standpoint, I think this is a very important area to be looking at because data centers need electrical equipment. They need backup power systems and power management. They need transformers, of course. They need cooling and engineering. They need construction. And they always need grid upgrades. And that brings us to companies like Eaton, ticker symbol ETN. Eaton is a power management company. It has exposure to electrification, data centers, electrical equipment. It really checks a lot of the boxes that we're talking about today. And then there's Vertiv, ticker symbol VRT. Vertiv is tied closely to power and cooling infrastructure for data centers. This is actually one of the more interesting niches in the whole story because as AI chips get more powerful, they begin to run hotter and cooling becomes even more important. So Vertiv has been one of the names that investors have associated with that trend of keeping those chips cool in the data centers. You also have Quanta Services, ticker symbol PWR. Quanta is more of an infrastructure services play. So if the grid needs to be expanded and upgraded, as we believe it does, companies like Quanta can benefit from that kind of spending. Then there's our number one Smart Score ranked industrial stock this month, GE Vernova, ticker symbol GEV. GE Vernova has exposure to power generation, electrification, turbines and grid solutions, and energy infrastructure. It really sits right at the intersection of power demand and grid modernization. And again, for those investors who prefer ETFs over stocks, there's at least a few. There are ETFs like GRID or GRID, which focuses upon, as you would imagine, smart grid infrastructure. Then there's also PAVE, PAVE. That's a broader U.S. infrastructure ETF that is also relevant, maybe not as relevant as GRID, but it's still relevant because it captures much of the broader infrastructure spending theme. And I think one thing to keep in mind about some of these different themes, especially when it comes to the grid infrastructure bucket, is that it may be attractive because it doesn't require us to know which AI model wins. OpenAI can win, or Google can win, right? Or Meta can win, or Anthropic can win. Some company we've never heard of may win. But if the whole industry needs more electricity, more cooling, more grid upgrades, and all of this, then these picks and shovels companies may benefit regardless of who wins the AI model race. And that's what I like about this layer. I mean, it really is the classic picks and shovels approach. During a gold rush, not everybody finds gold, but people willing to sell the picks, shovels, boots, and maps and supplies, they end up doing very well. So AI may be the gold rush, but power infrastructure may be the picks and the shovels. Now, let's bring all this back to some sort of process because investment themes get exciting, right? Investors love themes. They love narratives. AI, nuclear, uranium, natural gas, power infrastructure, it all sounds exciting. It all sounds compelling. But compelling is not the same thing as actionable. And at Follow the Money, we want to build a watch list first. Then we wait for the setup. We want to see which stocks are showing relative strength. We want to see which stocks are rising above certain moving averages. We want to see which ones are breaking out of solid bases. We want to see which sectors and industries are being accumulated by institutional investors. In other words, we just want to see where the money's actually flowing. Because as I mentioned, you can get the narrative right, but still hurt yourself if you buy the wrong stock at the wrong time. So here's how I would think about this AI power opportunity. You don't need to memorize every ticker I just mentioned. The point is to understand the investing map, right? You have nuclear power generators. You have uranium and the fuel cycle. You have advanced nuclear speculation. You have natural gas. You have grid and electrical infrastructure and cooling, right? That gives us the investing map. That gives us the idea of what we should be looking at. But then we apply discipline. As we drill down into those spaces, which names are entering confirmed uptrends? Which ones are way overextended in price and need time to cool off? Which ones are forming new bases, right? Which ones actually have strong sales and earnings estimates? Which ones actually have any kind of institutional demand? And probably the most important ones, which ones actually fit your own risk tolerance? And that's the work that every smart investor needs to do? These are the questions we need to ask ourselves, because our goal here at Follow the Money is not to chase headlines or to find exciting narratives. It's really to follow the money, which is to pay attention where the money is flowing. Now, one final thought before we close out this segment and move into our closing segment. And that is that the AI trade started with chips, and that obviously made sense. Chips were the first obvious bottleneck. But over time, markets tend to move from the obvious first-order winners to the second-order and third-order beneficiaries. And I think that's what we see happening here. The first question in AI was who makes the chips, right? The next question may be who powers the chips. And after that, who builds the grid? Who supplies the fuel? Who cools the servers? Who keeps the whole machine running? And that's why I think this AI power theme really deserves our attention. Certainly not because every stock in the theme is a buy today, although many of them have come down from their recent highs, so they may be more attractive than they have been recently. And of course, the story is not guaranteed to work out perfectly. Nobody knows the future. But when you have a massive new technology meeting an obvious physical bottleneck, that's something for investors to pay attention to. And I think that's where opportunity often hides. And that is why the right question is not just who wins in AI, who has the best model in AI, or whatever. The better question, I think, is who is going to get paid to power all of this. All right, stick around. We'll be back with my concluding thoughts and our final word. Hold tight. All right, welcome back to the final moments of today's broadcast. As we wrap up today's episode, I want to bring this whole conversation back down to one simple idea. AI may be one of the most important technology trends of our lifetime, but just because it's digital doesn't mean that it's not also physical, right? It has to be built. It has to be powered. It has to be cooled. It has to be connected to a grid, and it all has to make economic sense. That's why I wanted to spend this entire episode talking about AI's power problem. In retrospect, the first wave of the AI boom was pretty easy to see. It was all about the chips, right? And the cloud platforms, and all of these big tech companies racing to build the smartest models. But as we discussed today, the next phase seems to be getting broader and appears to involve nuclear power and uranium and natural gas, and obviously lots of grid and infrastructure upgrades. And that's why I want to remind you in all of this that investors just simply need to be thoughtful. I've said it a couple of times on this broadcast, but I want to say it again, it bears repeating, that just because you find a powerful narrative, it's not the same thing as a buy signal, right? A great story can still be a bad investment if you pay the wrong price, buy at the wrong time, or just simply ignore the trend. So hopefully you understand that the goal is not to just simply chase every stock that's connected to AI or has AI in its name or whatever. The goal is to build a watch list of great companies within a very major megatrend, and then let the market show us where the money is actually flowing. And that's really the discipline. The story or the narrative tells us where to look. The chart and the trend tell us when to act. Now, for today's final word, I want to leave you with a quote from science fiction writer Arthur C. Clarke when he once said, "Any sufficiently advanced technology is indistinguishable from magic." And that quote by Clarke really does fit this AI moment. Because if you've used some of these AI tools, you know that they can almost feel magical. You ask a question and an answer appears, or you describe an image and the image is created before your eyes. Or you give it a task and it starts working through all the steps. Or you give it data and it starts finding patterns that would have taken a human being hours, days, or maybe even weeks to uncover. It really does kind of feel like magic. But even magic needs electricity. Remember, behind every AI breakthrough is a very physical machine, requiring servers and chips, cooling systems and power lines, transformers, fuel and data centers, engineers and construction crews, and of course a grid that has to carry the load. So this episode is really designed to help you not to get swept up in the AI hype, and not to think that every company that has an AI press release deserves your money. We're talking about a major technological revolution that's running into a real-world physical bottleneck. The AI boom began with chips, but the next chapter is very likely going to be written in megawatts. So my advice is to stay curious and disciplined, build that watch list, respect the trend, and remember that your job is not to fall in love with some narrative, it's to follow the money. And that is just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and I'll see you right back here next time. Until then, God bless.
Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.